Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have back the CEO from Thermal Energy, Bill Crossland. Thermal Energy trades on the TSX Venture Exchange under the symbol TMG. The company is trading at 14 cents with roughly 164 million shares outstanding, or about a $23 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks so much, Trevor. Bill, great to have you back. We just saw some financial results out a couple days ago, so I would love to speak to that a little bit. But before we jump into that, Bill, why don't we talk about thermal energy and tell us, refresh everybody's memory. What does thermal energy do?
Absolutely. Thanks, Paul. So thermal energy, we're an established provider of unique energy and carbon emission reduction solutions for major global corporations around the world. The majority of our business, about 80% of our business, is repeat orders from a large list of, again, very large multinational companies. And we focus on multinational companies, A, because they're very large energy users, so we can do nice big projects for them, and B, because they have hundreds of sites around the world that we can then leverage that business into. So we have a unique portfolio of technologies that we deliver, and we deliver that really two ways. The main way we deliver our technologies and our projects to our customers is delivering turnkey projects where we design, and implement and install the solution for the customer with at a fixed price with guaranteed savings. That's about 70% of our revenue. The other 30% of our revenue is what we call customized equipment. So again, it's selling our proprietary technologies, but sometimes, occasionally, the customer just wants the equipment shipped and they'll install it themselves. That's about 30% of the revenue. And I mentioned, majority of our business is large multinational companies. We'll do a project basically anywhere in the world where they want us to go. We've got engineering and administrative offices in Canada, the US, and the UK, and we have our own salespeople, sales offices sort of in 7 countries, again, focused on North America and Europe. Again, just by way of background, we grew the business all with our own capital, so we haven't had a need to go back to the capital markets basically for many, many years. In 2015, we had about $6.8 million in revenue, right up to the point just before the global pandemic. For the 12 months ending February 29th, 2020, pandemic was declared in March, we had $25 million in revenue, $3 million in EBITDA, $1.7 million in net income. So that's where we were when the pandemic hit. Now, I mentioned that we do turnkey solutions. Obviously, that requires a lot of travel, a lot of site visits. So the very first thing that happened, early days of the pandemic, sites were locked down, there was no travel allowed. So that business, our turnkey solutions, was impacted very hard by the pandemic, no question. The other part of the business, sort of the 30% where we're just selling the equipment, that actually has continued to perform very well throughout the pandemic. We ended 2021, which is year ending May, with record order intake for our customized equipment and record order backlog. So that business is going very well, which is a really sort of a harbinger for the future as well. The turnkey solutions, these are big projects. They're a bigger ship to turn around, so they take a little bit longer. So we haven't seen order intake resume quite as strong there. But the good news is that when it comes to turnkey solutions, right now, we are working on 11 projects with our multinational customers. These are paid projects. This is where they are paying us to develop the project. So that's about 38% higher than pre-pandemic, and certainly the highest level in the company's history. So we feel pretty positive that we're on the right track, that the engineering team is very busy. and that it's just going to take a little bit more time. This pandemic is, as Paul said, we never know what's around the corner, but what we have become very good at is dealing with, letting business go on despite COVID. So we've sort of adapted. Travel is back on, site visits are back on. We're back visiting customer sites and have been probably for 6 to 9 months now with, COVID mitigation measures in place, but back developing projects. The other real positive thing that's happened is the pandemic really has an unbelievably positive impact on the society's demand and desire to reduce carbon emissions. This is the build back better approach. So we are seeing that from all of our customers. Customers before that needed a 3 or 4 or 5 year payback on their projects. Some of those now are saying if it's 10 or 20 years, we don't care as long as it reduces our carbon emissions. They have very challenging carbon emission reduction targets that are being demanded by their shareholders and ESG guidelines. So we're seeing that as a real positive to our business that's causing some good activity for us. At the end of the day, I think, we're well on our way of returning, to pre-COVID levels of performance and beyond. But, we still don't believe our current valuation reflects, either our recent order intake and project development levels or our proven growth and profitability that we showed prior to COVID, or the significant recent market improvements, as a result of a build back better approach. So, the other thing to point out is we did remain cash flow positive throughout the pandemic. It had a terrible impact on our revenue, but we remained cash flow positive throughout it. So we are still in a very strong financial position to be able to grow the business going forward. I got about $4 million cash on the balance sheet, $3 million working capital. So we're in a strong position out there looking to grow the business beyond where we were prior to COVID. So just really looking forward to the next 12 months for sure.
Bill, so I went through some of your press releases since we last spoke, and you also acquired, I don't know how to pronounce this, Sofam or
Sofam, yeah.
Okay, yeah, maybe tell us a little bit about that. What was the rationale behind that?
Yeah, so that's a company we've known about for years, and we've been trying to acquire their technology for years. They have some very complementary technology. So a lot of what we do, our core projects tend to be what they call indirect heat recovery. That's recovering energy from hot air. So it's basically air to water. So we're taking hot waste heat and creating hot water. One of the Sofam technologies is water to water heat recovery. So very complementary. So now you can capture heat from wastewater that's just going down, would otherwise just go down the drain. They also have what they call a direct fired water heater. So it's basically like a FLU-ACE or like a heat capture unit, but it also can heat hot water when you don't have enough heat sink. And so heat source, at least when we go to do our projects, we have to find a heat source. Where is there waste heat, and what can we use that heat for? Well, the projects are always limited by heat source or heat sink. There's always lots of heat source. And then another technology they have is a NOx emission. So it reduces NOx. We're seeing, particularly in Europe, you can scrub not only capture heat, but you can also scrub the emissions for NOx. They have hundreds of installations. The company's been around for a while, but they just weren't good business people. They sort of were profitable, and they basically just ended up with a lot of debt. So we were able to capture, or at least to acquire, all those technologies at quite an attractive price, and they're all very complementary. So basically, it gives us more technologies that we can then sell to our list of multinational customers, more products to more sites around the world.
Fantastic. Now, along with the financials you recently announced, you also announced $6.3 million backlog. Maybe just describe the backlog. What does it mean when you say backlog?
Yes, so backlog, it is a confusing term, but it is a good leading indicator. So backlog is basically orders received that haven't yet been turned into revenue fully. So as an example, if you had a $2 million order and you'd only revenued $1 million would be in backlog. And so it really is a good indication of what's going to happen over the next 12 months, because over the next 12 months, that backlog, those orders in hand, will be turned into revenue. It's important to point out that, as I mentioned, the customized equipment side is up very strongly. So, the customized equipment order backlog is 83% higher than it was at this time last year. And so all we really need to do at this point, so the customized equipment is really firing on all cylinders. All we really need to do at this point is catch up with the turnkey solutions. So the backlog number that we report is all products, turnkey solutions and customized equipment. But it's orders received that haven't been turned into revenue that's been disclosed in our financials. So, technically the backlog will keep increasing up until you report your financials, and then it drops by the amount of revenue booked for that, showing for that quarter.
Right. Yeah, that makes sense. So two questions I've got. You touched on both of them a little bit, but COVID, in the last discussion we had with you, you brought up sort of the travel restrictions around COVID. What sort of changes, if any, have you implemented right now? Are you seeing it easier to sort of work under the circumstances right now?
It is easier now. So there isn't really, there is still travel restrictions, but now you can travel pretty much anywhere. It's not nearly as easy as it was before. You have to show proof of vaccination. You have to sometimes quarantine, but our guys are now back out visiting sites without a lot of impediment. And it went around, it was, if you go back over the course of the pandemic, as you said, Paul, we were unexperienced at this, the world. We didn't really know how to deal with it. So if you think the first 6 months, sort of March to August of 2020, that was total lockdown. You couldn't go anywhere or do anything. Then in the fall of 2020, it got easier to travel. And then in the winter and the spring, it got more difficult. Of 2021, it got more difficult to travel again because you had your third and fourth waves. We're now seeing, with our major countries in the world are pretty heavily vaccinated. And I think we realize we just have to figure out how to live with it. So that's what we're doing. So for our purposes, business is pretty much back to normal at this point, almost, not quite. Maybe I'll call it the new normal, but it's getting pretty close to being back to the way it was before.
We've got a new administration in the U.S. Biden's Build Back Better, whatever the term is. Are you seeing any difference, any sort of more incentives around environmental issues and carbon capture and all that sort of stuff? What are you seeing right now?
There is more, and it's hard to know where it comes from, but I think now it's probably universal. What we're seeing, because the challenge for us is we operate in a lot of different jurisdictions, and in the US, every state is different, and in Canada, it's some provinces have one plan, other provinces have another. But what we're seeing is a universal demand to increase their carbon emission reduction targets. So as an example, Canada and the US just announced their targets for the first time, and it's 45 to 50% by 2030. The EU had a target of 40%. They increased it to 55. The UK went from 40% to 68% by 2030. Pepsi increased their target to 75%. So what we're seeing, whether it's as a result of politics or investor demand for ESG products, what we're seeing is our customers have very publicly stated their carbon emission reduction targets, and they're quite aggressive, and they're going to do everything they can to achieve them. It certainly helps the new U.S. administration because at least they're not. I think on the very first day of the new administration, they re-signed the Paris agreement, and we'll have to see what comes out of COP26, which starts in a couple of days, to see if there's any additional requirements. But the second point is, Paul, we are seeing carbon taxes, cap and trade prices everywhere, whether it's Europe or North America, and it's getting to the point that price of carbon almost pays for our projects. So, that develops a return for the customer on their own, let alone the energy savings.
Gotcha. What challenges, and especially new challenges, are you facing in sort of the economy we're in right now?
The challenges, for us are, as it always has been, one of our advantages is that we provide a customized turnkey solution. but that is a challenge to scale. No question, it's a challenge to scale. We think we've done as well as we can, and part of our strategy there is to focus on our key customers. So, we went through our list recently and we looked at, our top 8 customers, and our top 8 customers have generated about $37 million of revenue over the last 5 years. And that's at 68 different sites. And we're just getting started with those customers. But what we're going to do to try and scale better is place increased emphasis on working with our existing customers rather than trying to find new customers, because we've got enough to do with them. That one company in particular, back in September, we announced another heat recovery project with a multinational food company. That was the 3rd heat recovery project we did, and we've done $5 million with that customer so far at 7 or 8 sites. That customer has 150 sites, and that's not the biggest customer we deal with. Mm-hmm. So really to tackle this long sales cycle and scalability issue, we just want to focus on doing more projects with our existing customers that know us and trust us, and that speeds up the sales cycle pretty significantly.
Mm-hmm. Bill, we're hearing of so many issues around getting material, getting supplies, logistics, moving parts, things like that. Are you guys seeing that?
We are, admittedly, we are. Yeah, it's both materials and labor. The labor rate has gone up. So we didn't, despite the fact that revenue dropped pretty significantly during the COVID, now it's coming back, but it did drop. We didn't get rid of anybody. We didn't lay anybody off. We kept our existing team, but we all took a 15% salary cut, just trying to save some money. And we were cash flow positive through the pandemic. So we've now repaid that to our employees, are going to repay it. We did admittedly have to give a little bit of extra increase in salaries this year because the demand for good staff and good engineers is higher than it's ever been, for sure. On the materials side, it is difficult to get materials, and that's slowing things down a little bit. But we're not unique. I mean, that's the message we're getting in every market, from every customer, and the customers understand that. So certainly, no, people aren't canceling orders. They just realize it's going to require a little bit of extra time to get it through. And we generally have escalation clauses in all our contracts. So if we priced it based on one price, we can increase the price if need be, if we can't get it. But no, it is a tight situation for raw materials and for labor in virtually every market in the world.
Yeah, no, we're hearing that more and more from everybody we're talking to. So you're not the only ones, for sure. Maybe a little outside your expertise, but we've seen ESG based stocks and companies had a really, really strong last year, especially going into sort of the tail end of 2020. What are you seeing as far as interest in your stock? Are investors calling you? Are you, is the ESG interest still there, or is it waning right now?
I think the ESG is still very much there. I think it's only getting stronger, mostly for our customers, though. I mean, I don't know that a lot of our shareholders are buying us because of the ESG component to us. Obviously, we're an environmental company. They may be, but certainly on our customers. Our stock had a pretty good run back in March or April of this year, and that was largely because we were very active at that point on the investor relations, meeting a lot of new people, doing a lot of one-on-ones. We've spent the last sort of 6 months trying to understand what the next strategy is, and we want to get out there and start being more active again. We've seen the stock slide a bit. There hasn't been any fundamental change that I'm aware of between April of last year and now, and yet our stock price is sort of half of what it was. So my focus is to make sure the story gets out there. I think people just don't know the story of thermal energy. They don't know that we've proven ourselves to be able to grow at 30% compounded annually and profitably. Like I said, we've grown from the last time we raised capital was 2008, when we had about $4 million in revenue. We've grown that entire time without raising more capital. So we can grow the business, and we can do it profitably and on a cash flow positive basis. So we just need to get out there and tell more people.
Yeah, no, I think it's a great story, and I agree. It's all a matter of getting out there. Bill, sort of sort of, let's say in the next 6 months, what kind of catalysts or things should investors keep an eye out for with the business?
I think the next, I mean, it's more of the same. And again, it's come to my attention. I think the easy way to describe the business is our turnkey solutions and our customized equipment. It's basically the same product, delivering it a different way. You know, I've shown in the last press release that the customized equipment did very well throughout the COVID because it requires less travel and less site visits, continues to do very well. And our activity level in terms of project development, because as I mentioned, Turnkey Solutions, we design, develop, and engineer and install these projects. Our activity level with Turnkey Solutions is higher than it's ever been. So I would, you know, say just watch to see if some of those 11 projects that we're currently being paid to develop by our customers turn into orders over the next little while. It does take a while for, you know, when we issue an order, when we receive an order, if it's a turnkey solution, it takes, you know, there isn't a lot of revenue booked for 6 to 12 months. And that's, again, why we like to show people what the order backlog is at any given time. So they sort of understand what the next, you know, 6 to 12 months are going to look like. So to me, that's the key thing is, you know, some nice turnkey solutions over the next 6 months.
Nice, nice. And so the last question is, it's really a free for all for you. What sort of key takeaway do you want everybody to walk away with today to remember about the business?
Yeah, I mean, I'm kind of a boring guy. My story doesn't change. You know, I'm very methodical that way.
Boring is good. Boring is good.
We've proven ourselves. We have a strategy that's worked very well. You know, from 2015 right up to 2020, and we're well on our way to do that again. So I think we're going to continue growing this company. It is, you know, it is lumpy. It's, you know, when we get big projects, you're not the revenue quarter over quarter is going to be, it might be lumpy, but over the year, LTM, it's going to show a good trajectory over the next little while. And we're going to get back there. And our valuation right now is compelling. You know, it's less than 1 times revenue on a company that's has proven themselves to grow profitably at 30% compounded annually, organically. Forget about acquisitions. That's just organically. So we've done it before. We're going to do it again. And I think right now it's a pretty compelling valuation.
I like that. Good way to end this. Bill, if somebody wants more information on thermal energy, what's your website address, or what's the best way to get that information? Yeah,
thermalenergy.com.
It's simple, thermalenergy.com.
Thermalenergy.com, yes.
Awesome, awesome.
And certainly reach out to our investor relations. I'd happy to talk to anybody that wants to talk.
Fantastic. Well, this has been great. Thanks so much, Bill, for the update. We've been speaking to Bill Crossland, CEO of Thermal Energy, symbol TMG on the Venture Exchange. Listen, we look forward to catching up with you in the future.
Thanks so much, Paul.
Awesome. Thanks a lot, Bill. Cheers. Okay, perfect. Now I just got a message from Trevor that he's setting up another Zoom call on for another project. So we can just continue on the free for all. I'm sure Trevor will edit and cut the thermal energy interview appropriately. But at this point, let's just jump back into the free for all and open up to any questions, comments, whether it's about thermal energy, what we just talked about, or if you guys want to talk about anything else, the floor is yours. We'll let you have at it. What do we got? Anything. Where's Russell? I can always count on Russell for something. Do I see Russell there? There he is. Yeah.
How you doing, Paul?
Speak to me, Russell. I'm doing well.
Good. Yeah, there was a bit of news today for sure. You've covered, I think, all of it. I had a couple of questions, but most people have answered them. So AAP, I take it, like the idea is build that up, build up the share price by doing the NCIB, and then go out and do some acquisitions with a higher price. Is that kind of the way to look at it?
Yeah, I think the thing to consider. Value? Yeah, I think that the way to consider it is that I mean, management thinks the stock is cheap, so that's really the driver here. Whether it improves the share price to used as a currency, that's to be determined. I mean, you got to see a reason to use the currency. Otherwise, it's a function of the best use of current capital, capital allocation. So, the belief of management is that compared to its comparables, the stock is significantly undervalued, and compared to some of the acquisition targets that are out there, the stock is cheap. So theoretically, it's cheaper to buy the existing business than it is to buy, a competitor or another player that's out there. So it's capital allocation. Why would you pay 4.5 times EBITDA for an acquisition when your stock is trading at 3.5 times? It just makes more sense to buy back your stock. So that being said, the other side of it too is the currency itself isn't the only mechanism to go and make an acquisition. So you could theoretically, buy a business with cash or some sort of vendor take back or a number of other things. So just because the stock isn't a certain price doesn't preclude them from acquiring other businesses. So sort of keeping that in mind. But clearly the most important point is the stock has to be undervalued for this to be to be able to justify doing a share buyback like this.
Okay, so let's say 3 months from now, a good deal comes up at 2 times as opposed to 3.5 times.
Yeah.
Will there be enough cash around to make that deal go through, or line of credit, or bank loan, or shares?
So it would depend on the size of the acquisition, right? So as of the last quarter, you can see how much cash is on there. One thing I sort of note is that like a lot of these type of businesses where there's some seasonality, you have receivables, right? And the receivables get paid after a certain time frame. So the receivables turn into cash. So as long as you're collecting your receivables, your cash position significantly increases. Theoretically, the later on in the year, the higher the cash balance should be, and that makes it easier to go and do an acquisition. The other thing too is that with a lot of lines of credit or debt, the efficiency of the business or how well it's performing also allows for an increase in the amount of debt that's available to the company to pursue acquisitions or to run the business. So the better the business is doing, the better access it has to cash, and therefore it doesn't necessarily have to go out and raise money through equity or further lines of credit. But there is another way of acquiring, and a lot of times what you're doing is you're buying a business with what's called a vendor take back. So the current owner of the business is prepared to sort of lend you money to help with the transaction. So that's another possibility. There's a lot of creative ways of acquiring it, irrespective of what the share price is doing. Now that being said, the other thing too is that there's a number of warrants that are priced in at 60 cents. The stock is trading just below that. If the stock were to move, materially above 60 cents, you're likely to see a lot of cash come in through the exercise of those warrants. So there's a lot of sort of variables at play that could make it a lot easier to do an acquisition. But back to your exact question, it really depends on size, right? If it's a small acquisition, then there's a good chance the existing balance sheet can do it without any outside funding. And if it's a large one, then yeah, you have to look at the different options that are available to make it happen. So, yeah. So
have they noticed that businesses are asking more than they were asking before?
Yeah, well, yes and no. Like there's always going to be those that are going to try to maximize their value. The market is hot, right? The market has been very strong the last year. Private equity is out there on a regular basis for a lot of different industries, and they're paying up for assets. So you're going to see some that are going to try to be opportunistic and just price themselves sort of on the high end. But there's others that, quite frankly, it was a very busy year last year, and you got a lot of these these smaller owners that are kind of just exhausted. You know, they're in their 60s and 70s and saying, you know what, last year was a great year. I put a lot of money in my pocket and I'm just tired. I want out. So those are a little bit more likely to be a little more flexible in valuation. So it kind of runs the gamut, but you know, price by itself isn't the only thing you got to look for. You got to look for businesses that strategically fit and businesses that ideally you can improve and, you know, extract more synergies out of. So, you know, there's a lot of other factors that come into play as opposed to just price alone.
Okay. Okay, great.
Yeah,
Thanks.
does that make
Paul.
sense?
Yeah,
Perfect.
it does. Totally. Thanks.
Yeah. Perfect. Now, Alistair, I see a question around what do you think about the highly customizable nature of thermal energy? So what I really got out of that call with Bill, and he's still on, maybe we can touch to it a little bit, but I'm impressed by the fact that there's sort of the non-customizable part of the business seems to be doing so well. And I'm always a little bit concerned with businesses that have a high labor component. So your sort of pinch points are, you know, manpower, right? So a lot of when I hear customized work, when I hear, you know, sort of these contractual labor heavy you know, programs, I always get a little bit leery because it's very hard to scale. But when you get into these product type of markets, you know, that's much more scalable. It you know, not super scalable like software, but more scalable in these customized projects. So I was really happy to hear that part, sort of the more scalable part of the business is the one that's doing well. And hopefully, you know, the more labor intensive side starts to kick in as well. And then you've got something that really starts to look a lot more appealing. So yeah, I came away thinking a little bit more bullish because of that piece, probably more than anything else I heard today. So, but is it scalable? Yes, within reason. You got to think about it, right? There's still all the issues around any kind of heavy good production. You know, machines and hard goods that fall on your foot and will hurt. Those are scalable to a degree, but at some point you've got to increase manufacturing capacity, or you've got to increase your you know, sort of third-party manufacturing if necessary. You got to source more parts, all that sort of stuff. So you do have more pinch points, but yeah, happier to hear that there's a little bit more growth in the little bit more scalable side of the business. And Will, I mean, your mic's free. Maybe add anything you want into that if you can.
Yeah, no, that was a good summary. The way, I mean, often the way we scale it, and I touched a little bit on it, is I mentioned that when we go to a site, we need to find a heat source and a heat sink, right? There's always way more heat source. There's always lots of waste heat, but do they have a need for that waste heat? And a lot of that is application specific. So the way we scale it is we work with these corporate accounts. And so often what we'll do is we'll develop a project for them in a certain area of their business. So as an example, you know, we worked with a multinational company that was generated fish food. They, you know, they do a lot of things, but they do fish food. So now they know we do a project in fish food, and they know, okay, we got a bunch of other plants around the world that are just like this one, manufacturing the same product with the same sort of applications. We know you can do that. And that's usually how we grow the business and scale it. So as an example, one of those 8 customers, you know, we did, there were those major corporate accounts that we did, they had a division that was bottling something. And what they were bottling, they were using a process called hot fill, which just simply means they fill the bottles hot, and that's how they sterilize it. So we did a project for them on their hot fill, and then they realized, okay, now we know how to do hot fill, and so we've done 8 projects now with them at other hot fill plants in North America. So that is why we've come to the conclusion that, look, we need to focus on our customers that know us and trust us, because they know what we can do, and they point us in the right direction. They know where the applications are that they're going to save all the money, and so that is basically how we scale it. We're not constricted often by labor on these big projects. It's this long sales cycle, because a lot of it is detailed engineering, and if we get to the point where if we've got too much engineering that our own team can't do it internally, then you know, we can always outsource the non-critical parts. So that's how we're dealing with the scalability issue. But it is true, every project is slightly different.
Yeah, and to touch again on what you said earlier too, that was one thing that always appealed to me about your business is you have such a sort of a large target, sort of an addressable market just in the existing customers you have. You really almost don't need a sales force anymore. You're really going after your existing customers and saying, okay, where next?
Absolutely. And
Yeah.
I've said that to the sales team numerous times. I've said, we don't really need any new customers. We just need to focus on selling more to the customers we already have, because they know us and trust us and they like us. So, let's stop, chasing the shiny coin over there somewhere. Just go after the tried and true. And that's really part of the strategy that we're implementing now, really focusing on those top 8 customers, because there's more than enough business with them alone.
Yeah. And Bill, one question I didn't ask, and Alistair's brought it up, but we always ask now, what do you think the business looks like 5 years from now? Like, not necessarily just revenues, but like, geographically, new products, new initiatives, just 5 years from now, what is that?
Yeah, 5 years from now, I mean, we're gradually, people talk about we are energy efficiency. So we're helping people use less fossil fuels generally. And so a lot of people think, well, geez, fossil fuels are on their way out. And I say, well, first of all, it's 50% reduction by 2030 and net zero by 2050. So we got 39 years to go, or 29 years to go, I guess, to 2050. But on top of that, we're already moving in that direction. We're already looking at thermal renewables opportunities with our customers, and our customers are getting us to do that. And not only that, but even if it's a renewable source of thermal energy, and thermal energy just means heat energy, even if it's a renewable source like biomass or biogas, they have to use it efficiently. So a project that we just announced a few months ago, it was a brewery. We were shipping it to their plant in Russia. That was for their own biogas plant. It was to improve the efficiency of their own biogas plant. So if I said 5 years, it's going to be more of the same, but we will gradually move into renewable energy efficiency as opposed to just sort of fossil fuel energy efficiency. But that's many years down the road yet.
Yeah. Well, I didn't really think about that, but that's interesting, because I just kept picturing, brownfield projects, right? A facility that's been doing the same thing for 40 or 50 years and needing, more efficient way of capturing that energy. But you're right. This lends itself to, sort of moving heat into energy from almost anything.
That's right. Yeah.
Oh,
And
cool.
from anything. From anything to anything. And again, that's something that we have realized our existing customers get us to look into as well. One of our customers a year or so ago got us to improve their efficiency of their solar thermal plant. Again, it's just all about energy efficiency, thermal energy efficiency. So we're very good at anything to do with, fluids and heat. And so, that covers a lot of territory. So 5 years from now, we will continue be doing, bigger projects, and we will be moving more into renewable probably. But still, the biggest part of the business, I would say, for the next 20 years is going to be fossil fuels.
Yeah. And I know we touched on it the last couple of times we spoke in the past, just about, I mean, you guys don't really have anything in the ways of recurring revenue, but you were looking at different ways of generating some form of recurring revenue. Do you have anything yet? Do you have anything in the future you're looking at? What can you tell us there?
Yeah, listen, we always, every so often, the quick answer, Paul, is no. We don't. The corporate accounts selling, repeatable orders from our existing client base is as close as we get to recurring revenue. Listen, we would love to be able to own our projects and and just sell the saved energy back to the customer. But so far, nobody's willing to take us up on that offer because they would rather own it themselves. But that's the most obvious solution. The challenge with that is that the only way to make that work is when they come to you and say, well, okay, but how much does it cost for me to buy the project? And you have to say, no, we don't sell it that way. Sorry, this is the only way you can do it. And I'm not sure we'll ever get there because the likes of the companies that we deal with have a cost of capital much below ours. These are massive companies with billions of dollars in revenue. So they're always going to want to own the equipment, it would seem to me.
Yeah, makes sense. Perfect. Well, there you go. Bill's answered your questions. Awesome. Thanks so much, Bill.
No problem.
Okay. Where else do we want to take this? I don't know if Trevor's back. Trevor, as soon as you're back, just, or if you can hear me, let me know. But otherwise, we can go into any other questions you guys have. We can talk a little bit about the SNN conference. Like I said, we're actually pretty happy to say we've got a number of keynote speakers that we're pretty happy about, covering a bunch of different industries and topics. So I think that'll be interesting. I think the company lineup is around 50 so far, so that continues to grow. So yeah, I mean, if there's any suggestions, we're open to suggestions in terms of how we can make it, best use of time for everyone involved. Feel free to let us know. Otherwise, yeah, what else can we talk about? Okay, so we got here. I took my original capital out of ACU, but kept some free ride shares. What do you think the odds are the company goes belly up? I don't think the company's going to go belly up anytime soon. The concern that we talked about early on about the sort of their lack of revenue in a couple quarters and their sort of delays in commercializing that software, I think continues to hold. So we're still not comfortable enough right now to look at buying right now. I think the stock's starting to hit some 52-week lows. So the delays are the concerning part. I think they've got sufficient capital for the next little while. I also think they've got enough invested in investors that should there be a need for capital, they'll get more, but at the cost of further dilution. But my concern isn't the company going belly up right now. My concern more is the delays are just going to likely increase the risk of the company needing more financings and further dilution. So not even close to being my top pick. So I wouldn't be looking at buying it. I think there's better opportunities right now until we see that validation of the commercialization of that software. I still think it's got tremendous upside. But I think we can afford to wait and see, significantly more confirmation that things are going in the right direction and the delays are gone. So, I mean, you look at a lot of the companies that we look at. I mean, we try to take a sort of a risk assessment first before we worry about what the upside looks like. So it's not enough people really understand financing risk and what that can do, especially if a company is in need of money. The best way to assure that the company doesn't need money is, the company's making profits. If the company's not making profits, then you run the risk that at some point they got to go back to the market and raise money. And the last thing you want is for a company desperately needing money when the markets are bad and they can't raise equity. That's where the danger really comes up. If things are, the market's really hot and bullish and all that, yeah, money's easier to raise and the risk is a little bit less, but you can't predict that sort of stuff. So we try to make sure that we've got several years worth of capital in place, ideally not burning money, even better making money, and you want to take that financing risk completely out of the picture as much as you can. And if you can match that with real significant upside, well then you've got a real good chance of having a big winner without significant downside. So Bill sort of talked about boring is boring or whatever it was, but we like boring. We like boring companies that make money because it takes that financing risk really significantly out of the equation. So ACU right now, while I don't think it's going to go belly up anytime soon, it's the financing risk is increased, and that's why we're staying away. Okay, so what are your new top picks? Did you put any money into Snip? So you know what, I would. So the answer quickly is no. I haven't put any money into Snip yet, but I actually think it's probably right now in the sort of top 5 to 10 companies out there. We're starting to see, at least fundamentally, we're seeing that side of the market. These ad tech companies get fundamentally pretty good numbers are getting put together, and you're starting to see that at least some of these stocks have stopped going down, and most of them are now actually starting to go up nicely. We saw, good reaction with Zoomed as far as their, increase in guidance, and it had a positive impact on the share price. Snip has been hitting 52-week highs, which is something I always like to see on the back of, decent fundamentals. So I think, while it does have a little bit of financing risk, because the CEO has even mentioned that he'd like to at some point raise some more money. I think he's, it's not a necessity. So, I like Snip, and like I said, it's up there, at least in my top 10. I'd say it's up there. Some of the other names I'd add to that, I mean, I'm going to go back to names, you guys have heard me said before. We actually had a good call with a company called Fabform again today. It was brief, but we were really trying to understand if there was an opportunity to perhaps finance the company. They're sitting on $1.6 million in cash, and they've got no need for it. They're making money. So here's a case where, the downside is very protected. Stock is extremely off the radar screens of anybody. Very tight share structure, nicely profitable, strong trend within the business, and some optionality on some of the new products they're working with. So I would, that is, as much as it's moved in the last little while, I think it's up about 60% since we highlighted about a month ago. I think it's got significantly more upside, and as it gets a little bit more recognized, and possibly, with Q3 numbers coming out here, that by our impression, especially after having a site visit and seeing that pretty well everything is going out the door as fast as it's coming in, I think that one looks real good, and I think there's some good upside there. So that one, I can't talk about any of the ones I'm sort of a director of or involved in there, but I'm pretty happy with some of the stocks I own there. What else am I seeing out there? At Geodrill, we're quite likely. Well, I mean, I can say it. We're likely going to be issuing a report on Geodrill. I think it's if you want to play the mining space, I think that is the way to play it in a more conservative way. Valuation is very compelling. Technically now the stock looks like it's reversed its downtrend, so I like the technical side of it. And arguably, albeit last day or two, some of the commodities have actually turned a little bit more negative. I think there's potential for a good upside in the resource space. So the Geodrill provides drilling services for most of the major miners in Africa, mostly West Africa, and somewhat in Latin America and Egypt. But the valuation is really compelling, so we like it. And like I said, a good sort of way to play the resource space if you think it's going to continue to get bullish. And we're not so much gold stocks or some of these. You're seeing a little bit more esoterical minerals that are hitting highs, but it's the money's out there, and service providers like that I think are going to benefit by it. So I like that one. So there's sort of three names. I wouldn't say they're necessarily my top three, but they're in easily my top 10. Geodrill, Fabform, and Snip. So, and listen, I welcome any comments, any questions, on any of those three or any other company. Feel free to just chime in and say what you think. Or don't say anything, or let me just continue to talk incessantly here, and hopefully it makes sense. What else can I say? Trend-wise, not really seeing any new trends out there. Oil and gas stocks that are hitting 52-week highs, still seeing a lot of oil and gas stocks hitting 52-week highs. Some service companies in that space are starting to put together some real good fundamentals. financial results that look real strong in some of these companies. So yeah, it continued sort of strength in that market. I mean, some of these were so egregiously undervalued and due for a run that it's you can argue some of these oil and gas stocks are still extremely cheap, but I've said it over and over again that not something I specialize in, and wouldn't be able to tell you which place there to really look at. Off topic, did Bank of Canada buy gold? So you know what, I did see something about, and it just is more a headline than anything else, but that the Bank of Canada increased their gold reserves or actually reestablished a gold reserve. So I don't know how material it was, but and don't really know what that means, to be honest with you. I don't know what that means. Is it a indication that we're going to see more buying by central banks? Hard to say. A lot of central banks were sellers of gold over the last 10, 20 years, and yet we've seen gold prices continue to go higher. I don't know if central banks' actions are necessarily the best indicator of any kind of trend. Never trust governments. They're almost probably the what is it, reverse indicators or contraindicators. So I don't know if I'd put too much weight in the Central Bank of Canada. Reclaim. Pankaj says, Reclaim MYID launches My Footprint to show who's buying your data. Yeah, I didn't see that press release. I'd have to look at it, see if it really means anything to me. When I first looked at the company, I did mention that I took a trading position in it. I since sold it. Didn't really see much in the way of follow through. It was more technical trade than anything else. I don't think I made money. I may have at the best broken even, but something I'll take another look at. But if it doesn't sort of meet my fundamental requirements and criteria, it's typically going to be a short-term stint. And I'm trying to really focus on the bigger opportunities where the fundamentals are there, less about promotion or sort of optimistic upside, and more about good solid fundamentals that I can build big positions around. So okay, Dan says Bill Crossland said that they are getting back to pre-COVID levels. Sales in the year end May 2020, they generated 15.3 million sales, wrote off 3 million in goodwill impairments and loss 1.9 million. In year end May 2020, they did 21 million in sales and lost 450K. Did Bill say anything to suggest they'll make money this new year? Well, I mean, he can't necessarily say what the new year is going to look like, other than to say that the bookings, or sorry, the backlog is going in the right direction, and now that sort of COVID is less an issue, that they should see some more of these larger sort of customized projects, sort of secured. So I mean, the expectation would be that there should be some improvement here, subject to any black swans out there. So Bill, I don't know if you want to add anything to it.
No, you hit the nail on the head, Paul. You're exactly right. I mean, just to clarify the numbers a little bit, the numbers I like to use to really compare pre-COVID is the 12 months ending February 29th, 2020, because the pandemic was declared March 12th or 13th, 2020. So for those 12 months, we had $25 million in revenue, $3 million EBITDA, and $1.7 million in net income, net profit. For the year ending 2020, we only had $21 million in revenue, because as soon as we saw COVID hit, the revenues dropped to less than half of where they were prior to COVID. So they stayed that way for a while. They're gradually starting to build back up the revenues, but more importantly, as you pointed out, Paul, it's the activity, the order intake, which takes a while to turn into revenue, the order intake, order backlog, and the development of Turnkey Solutions that has picked up very nicely, which seems to indicate we're getting headed back in the direction of pre-COVID levels of performance and beyond. So
there you go, from the horse's mouth. Perfect. Thanks so much, Bill.
And unfortunately, Paul, I got to jump off now. So I appreciate the time. Thanks so much.
Thank you so much. Thank you for everything. You bet. Thank you, Bill.